Welcome back. You're tuned into Chartbusters. The next company on our radar is Tega Industries. The company, well, they're guided for around 15% revenue growth. It's come in a little bit lower than that. However, the margins have come in at multi-quarter highs in the fourth quarter, and the street seems to have caught on to that. To discuss the numbers, the way ahead, we're joined by Mr. Mehul Mohanka, the MD and CEO of the company. Hi, Mr. Mohanka. Good morning. After a while, we're chatting, and it's good to have you on the show. Give us a few details, though. Going by the start of the year, we're already a couple of months into the year. For FY26, what kind of a growth are you looking at? And if you could split it up for us in consumables as well as, your equipment business, what kind of growth can you look at in both these two verticals? Please go ahead.
Sure, happy. So, as you know, in FY25, we delivered a double-digit growth, which is of 11%. And our gross margins have held steady at 57%, and EBITDA has moved up to 23% from traditionally being at about 21%. So the quarter four was very healthy for us. And if you actually look at our 5-year growth trajectory on a CAGR basis, we've been in excess of 15%. And we're looking at FY26 to be equally strong, to be anywhere between 16 to 17% growth over FY25. In terms of consumables and equipment, we're looking at consumables to be at about 15% growth, and equipment should be in excess of 25%.
All right. So that obviously tilts the favor in, or tilts the scales in favor of equipment in terms of contribution coming ahead. Margins, you said 23% margins is what you've done in the fourth quarter. Typically, you guide for a 20 to 22% band. Just wanted to know whether this will structurally improve as your higher margin businesses increase in contribution. And when you speak about higher margin businesses, Dynaprime, how did that grow in FY25? You had guided for what, 25 to 35% growth out there. What's your target here?
So Dynaprime for us grew in excess of 28% in FY25. And we're seeing continued traction for that product segment going into FY26 as well. So we would expect it to continue to grow at those levels, even going into FY26, though the base has moved up, but the growth rates will remain the same. 25 to 35%.
Yes. All right. Give us a broad understanding then in the consumables business. Earlier, if we had looked at the mill liners, I think the mill liners and non-mill liners were in the ratio of around 70-30. That's the last number that I have.
Yes.
You could tell us where do you expect this ratio to stabilize at? And Dynaprime, how much is it contributing currently? And where does it head to since it's growing at such a fast clip?
So I think the ratio will remain around 70 to 30, maybe move up more around 65-35. But we don't expect it to change dramatically over FY26. And Dynaprime, as I mentioned, we have multiple opportunities right now where we are trialing the product with new customers in different geographies. And all of that, which were wins in FY25, will convert into orders in FY26.
How much does it contribute right now?
So Dynaprime, I think, is about close to almost 45% of our entire mill business. And I think it will continue to be trending around those levels between 45 to 55%.
Okay, interesting. It's been a while since we spoke, actually, Mr. Mohanka, because the last time around it was, I think, in the 30s and now it's at around 45%. So clearly that's growing very, very well. If you could help us with your updated market share, are you outgrowing the industry? And if you could tell us how much exposure do you have to the United States as of now?
So market is growing at, our estimate, though there's no credible data in the space, but we expect it to be growing at about close to 1.5 to 2%, while we're clearly growing at like, for example, FY25, we were growing at 11%, and it's going to be a stronger outlook for us. So we're completely outstripping the industry average.
So you'll be gaining some market share, right? Going by the data. As per your estimates, what should it be? It was at around 5%. Do you think it's headed?
We put ourselves at about close to 7.5 to 8%.
7.5%. All right. And double digits by when, since you're outgrowing the market?
So we expect at least by FY28, by the time our Chile capex comes completely online and the plant is stabilized, we would expect it to grow into double digits by then.
And what is the likely turnover from Chile once the capex is completed? How does that aid your overall businesses? And to add to what Nigel asked about US, how much does that account for in your overall sales? And Is the tariff-related uncertainty going to impede your growth there?
So Chile at full capacity will be about 1,000 crores by the time it comes online completely. As far as US tariffs are concerned, Tega as well as all other peers in our industry export into the US. We don't have any local manufacturers. And our overall exposure to the US market is a very insignificant amount of our total percentage of revenue. So going forward, we don't see a material impact on the tariff. Whatever it be, in whichever form, I think it'll be applicable to all our peers as well. So I think there's going to be a neutrality effect on the pricing per se.
And when does the entire Chile thing come on board? When does that start contributing to your revenues?
We expect it to go into commercial production by end of Q2 of next fiscal of FY26.
Okay. All right, Mr. Mohanka, one quick question on this equipment business. It's a bit of a turnaround story out there because you'll have taken over this business and the results are showing as well. So kudos to you as well as the team. Can margins improve further from here? I'm looking at your Q4 numbers. They look blockbuster. You're going at a run rate of around 80 crores per quarter and the EBIT margins are at around 16%. Scope to improve?
Yeah, we see it, at least there's scope to improve by about 200 basis points. And that's what the attempt will be this year. When we first bought the business, it was at 5% EBITDA. We improved it to 9%. And now it's at 13%. So I think it continues to grow. And our aspiration would be to at least add another 200 basis points incremental margin expansion.
So what does that do to your margin guidance? We didn't get the outlook here. Should we look at that 20 to 22% range structurally increasing to 22 to 24% and thereafter beyond that as well? What's the steady state outlook here?
Yeah, I would say it would, from us guiding it around 20 to 21, we would say now we would be more optimistic to say it would be between 21 to 23%.
21 to 23 for this year and thereafter?
Yeah. And thereafter we expect it to continue to stay at about 23 to 24% odd levels, but I wouldn't try to outreach myself at this point.
All right. And what's the order inflow that you expect this year as well? Your current order book is close to around 1,000 crores.
Yeah, so we closed March at about 1,030 crores and we're seeing steady demand for our product lines. As you know, gold and copper both continue to remain strong and we have enough and more demand that we see from customers for the order book to continue to remain strong going into the subsequent quarters.
Okay, all right. Appreciate you joining in, Mr. Mohanka. Thanks a lot for joining in. And in fact, we'll hold you to these numbers, but going by the tone of it, it appears you're quite optimistic on the prospects of business.